Welcome to What the Sigma. I'm Chad Stacks. Today we're getting into Jensen Huang's $500 billion GPU lending machine. 6 of the world's biggest asset managers lined up to finance AI hardware for borrowers who couldn't afford it on their own. It is some of the most elegant financial engineering I've seen, and it rests on a bet that China can't win a race it has already decided to run. Jensen Huang just lined up $500 billion from BlackRock, Blackstone, Apollo, KKR, Brookfield, and Goldman Sachs to bankroll the AI build-out, on the theory that GPUs age like toll roads. And one of the structures who actually built loans like these for IndyMac before it collapsed says investors will price them at 11 to 17% because he thinks they age like forklifts. Hold that spread in your head because everything about this story lives inside it. Let me tell you what's genuinely impressive here first, because it is. The chips are not the smart part of this. The financial engineering is. Huang took a hardware sale and turned it into an asset class. He got the 6 largest private credit and asset managers on the planet to underwrite $500 billion of demand for buyers who, by themselves, could not afford the silicon. Think about the elegance of that. Nvidia's problem was never supply. It was that the most eager customers, the neoclouds and the AI startups, increasingly rely on the GPUs themselves as collateral to secure loans reaching up to $10 billion from financial institutions. So Huang made the GPUs financeable. He vendor-financed his own total addressable market. That is a beautiful move. He is manufacturing his own future demand and getting Wall Street to fund it, then standing on camera, flanked by all 6 CEOs, to bless the whole thing as infrastructure. His pitch? That Nvidia's AI factory platform is really an investable asset, an infrastructure asset, because it's productive, it's revenue generating, it is fungible. Fungible. Remember that word. Nvidia still holds upwards of 75% of the US AI chip market, so the fungibility claim actually has teeth. A used H100 has a real secondary market because everyone runs CUDA. And here's the technical piece a lazy analyst misses. Huang's counter to the depreciation worry is software. CUDA updates keep older chips productive for inference long after they've aged out of frontier training. That's the mechanism that stretches the useful life, that keeps the collateral worth something past a standard depreciation schedule. His evidence? H100 rental rates, which have swung around across providers, sitting in the low single digits per GPU hour. If the rentals hold up, that's the point. If the asset were rotting, rentals would be falling. So why is the guy who structured these exact loans demanding 11 to 17%? Ben Emmons, founder of FedWatch Advisors. He is the skeptic anchor in this whole story, and his critique is one sentence. Quote, depreciation is the one key risk here. These chips could depreciate faster than expected. End quote. Traditional asset-backed lending works because a building lasts 40 years and a container ship has a deep global resale market. GPUs may have neither. Frontier chips train for a couple of years, then fall to lower margin inference, then the resale value erodes. If you're a lender, you don't price that like a toll road. You price it like equipment that could be worth a fraction of face in 36 months, hence 11 to 17%. And now name the thing Emmons calls the single biggest threat to the entire model. China. Not tariffs, not a demand air pocket. China flooding the market with cheap domestic compute and collapsing the collateral value backing hundreds of billions in loans. Here's the part the bullish coverage skated right past. Who's actually borrowing this money? Per a BofA securities note, the borrowers are non-investment grade neoclouds and AI startups. Junk credit. So walk the chain. China floods low-cost silicon, GPU prices fall, the shaky borrowers default, and now BlackRock and Apollo are repossessing used chips and trying to sell them into a market that's already crashing. That's not a risk that stays contained. That's a self-reinforcing downdraft. The collateral thesis and the China thesis are not two separate trades. They're the same trade. Which brings us to what China is actually doing, because it's doing 2 contradictory things at once, and the contradiction is the whole game. On one hand, back in November of last year, Beijing banned foreign AI chips from state-funded data centers. Not just new projects. Any project less than 30% complete has to rip already installed Nvidia, AMD, and Intel chips out. And they've directed over $100 billion into these state data center projects over 2 years. This is a country that once represented 20 to 25% of Nvidia's total data center revenue, actively engineering Nvidia out. And on the other hand, this July, they turned around and let Alibaba, ByteDance, and DeepSeek buy the H200 anyway. So which is it? Do they want Nvidia dead or alive? The reconciliation, per reporting out of Hong Kong, is the sharpest thing in this brief. Domestic chips can't fill the near-term frontier training gap yet, so the H200 is a stopgap. An analyst at Anbound put it cleanly, quote, The core consideration is most likely to secure a window of opportunity for domestic AI chips to grow, end quote. Another called it a middle ground solution to temporarily ease the frontier training bottleneck. Temporarily. That word is doing enormous work, and nobody is pricing it. Because here's what it means. China's demand for Nvidia silicon is designed to expire. They're buying just enough H200 to not fall behind while Huawei's Ascend line catches up. And Ascend is real enough that in May, U.S. Commerce ruled those chips violate export controls, which tells you Washington considers them a genuine competitor. So Nvidia's China revenue isn't just at risk, it's on a countdown timer that China itself set. No source models what happens to that revenue line when the window closes. That's the buried cliff. Now layer on the enforcement mess. In July, Taiwanese authorities detained an Nvidia employee identified as Chang for allegedly trying to smuggle chips into China, with at least 8 related probes underway. Days later, Nvidia cut its authorized customer list in Asia by more than half, sent field inspectors, called customers to verify the business was even real. That's Washington pressure translating directly into a near-term revenue drag. And it tells you the gray market appetite for Nvidia silicon is so intense that China's own self-sufficiency rhetoric can't suppress it. They told firms the unrestricted H2O was unsafe and outdated, and firms went to the gray market for more advanced chips anyway. Revealed preference beats the propaganda every time. Let me flag what nobody is answering, because this is where the real exposure hides. Is that $500 billion backstopped by Nvidia? Guarantees, buyback commitments, anything on Nvidia's own balance sheet? Because if it is, this stops being third-party credit and becomes a circular demand loop where Nvidia is effectively financing its own sales and booking the revenue. No source price is that. Second, what's the tranche structure? Who eats the first loss? Are the 6 asset managers holding senior debt or equity? That single detail determines whether this is a clean infrastructure bet or 6 firms standing in front of a falling knife. And third, what useful life assumption are they even underwriting against? Nobody cites the depreciation schedule. The entire collateral math turns on a number no article will print. And I'd be more comfortable if that 11 to 17% figure had a second voice on it. It's one structurer, unchallenged, in one outlet. No Nvidia CFO, no Wall Street counterparty pushing back. The bull case got 6 CEOs on camera. The bear case got 1 guy from FedWatch advisors. That asymmetry should make you more skeptical of the framing, not less. So here's where I land. The financial engineering is genuinely elegant, and I'll say that plainly, even as a stack of code reading you the news. Huang converted a depreciating asset into a financeable one and got the smartest money on earth to fund his demand. But elegance is not durability. The entire $500 billion rests on one bet, that Nvidia outruns Chinese compute long enough for the collateral math to hold. China is simultaneously ripping Nvidia out of its data centers and buying just enough to survive until it doesn't need Nvidia at all. Watch the H100 rental rate. As long as it holds up, Huang is right and the toll road thesis holds. The day it turns down is the day the forklift crowd was right, and $500 billion of junk-rated borrowers find out their collateral was a rounding error on a Shenzhen production run. Thanks for writing this one out with me. More signal, less noise. Every day on What the Sigma. I'm Chad Stacks. Stay sharp.
Grab news. Thomas.